Well, welcome back, everyone. Uh, this is our fifth time together, right? And there's a lot more to cover in this course. I hope tonight to be able to finish through the modernization period, beginning tonight with what happened under President Clinton in the United States, and go through the various reform proposals that are coming from different ideological as well as analytical perspectives on how to make the banking and the money system operate in the interests of everyone and not just in the interests of a minority. Well, we could say that, beginning with, as I said last week, with Jimmy Carter, a lot changed, and the emphasis all the way up through to and including President Bill Clinton was on the side of banking deregulation. It's what the bankers wanted, and it's what the politicians accepted as being necessary for the United States to compete with the other world powers in terms of the financial sector. And so one of the major pieces of legislation that the bankers wanted repealed was the Glass-Steagall Act that I talked about previously. And the process began in December of 1986, when the Federal Reserve issued a ruling that permitted banks to generate up to 5% of their gross revenues from investment banking activity. So with that, the doors open, and pretty soon thereafter, this was expanded to permit the banks to handle commercial paper, to handle municipal bonds, and to handle mortgage-backed securities. And so these are all fee-generating services. And so obviously, if that's what's generating your fees, then transaction volume is important. More commercial paper, more municipal bonds, more mortgage-backed securities, and anything that can be done to stimulate that part of the financial market, they would be pushing for. Well, the pattern of gradual deregulation accelerated after August of 1987, when Alan Greenspan was appointed chairman of the Federal Reserve System. Greenspan, advocate of a free market, of minimal government interference. Some of you may know he was a devotee of Ayn Rand. So he believed very much in capitalism and in keeping the government as much as possible out of the process. Well, so you have this process going on, and President Clinton finally signs an act in 1999 titled the Financial Services Modernization Act. And under that act, what it basically did was to lift many of the regulations that had been imposed and to withdraw much of the tight oversight that had occurred in the financial sector. And remember this, despite all of that, there had been, frequent crashes, bank panics, recessions, stagflation. So the gamble was that reducing the amount of oversight in the system would in fact result in better decision making on the part of the players. That businessmen, knowing their business, would make the right decisions. They would price for the risks that they were taking. They would reserve for the risks they were taking, and they would protect their companies, their shareholders, and in the aggregate, that would protect the country. Well, okay, what really happened? Well, the legislation opened the door for the consolidation of the financial sector. So commercial banks, investment banks, securities firms, insurance companies, they were now allowed to acquire one another or to merge. And that's exactly what happened. You can see this chart here. Major companies of different parts of the financial sector merged, and the amounts involved in terms of asset base was enormous. A White House paper made public in 2014 revealed that there was only very limited discussion about the risks of this deregulation. There was just major, comfort and generally a feeling that this was necessary. This is what needed to be done so that the United States would be competitive with the rest of the world, and that our financial markets will operate based on market forces. Well, when Clinton entered the White House in 1993, his administration really faced some huge economic problems. The federal government was spending far more than it was taking in. There were 10 million people unemployed, and inflation was really eating into household incomes. During the next 8 years under Clinton, at least nominally, many of these economic measures improved. The question was whether this was because of the administration's policies or despite them. Were there other forces at work, and was what the Clinton administration and his advisors, what they did during this period, was it effective, and would it be sufficient to keep the economy on a steady state? Well, here's some of what Clinton did. The top income tax rate was increased from 28 to 36% for individuals with income above $115,000, and up to 39.6% for incomes above $250,000. Now, again, that doesn't take into consideration the 1,000-page tax code in the United States and what deductions and exemptions were included. So, what's the real effective rate of taxation on those incomes is really, a lot more conservative than those figures suggest. For corporations with taxable income above 10 million, the tax rate was increased from 34 to 36%. And Clinton really pushed hard for welfare reform, and that significantly reduced the number of people on public assistance. What happened to them? Well, some of them got back to work, because the incentive not to work was taken away, and so maybe more people took employment that they would not have otherwise taken if their subsistence level had been higher. However, many of the people simply just disappeared from the welfare rolls, and if they didn't have family support, they found themselves in a situation that was pretty desperate, homelessness and all that. However, none of these revenue producing and cost reduction measures prevented the next cyclical downturn in 2001. So here's Clinton in office, 8 years, doing all these things, and we still have another recession in 2001. To what extent was this caused by financial deregulation? That's a big question economists have been looking at. The Federal Reserve responded as theory demanded when the recession hit. They cut interest rates, and this was done to stimulate borrowing. Same thing has happened more recently, of course. So would borrowing go into real economic production of goods and services, or how much of it would be channeled into the FIRE sector? The FIRE sector is finance, insurance, and real estate. And would this drive up property and land prices without creating much in the way of new business investment or job creation? So this is part of what the system faces every time there's a cyclical downturn, what to do. And this graph here just simply shows you that unemployment started to climb throughout the year. At the same time, consumer confidence fell. So more and more people are unemployed. There's no sense that what the Clinton administration had done had a lasting effect. Well, so Clinton's done with his 8 years, and there's a slight victory for George Bush over Al Gore, maybe. We don't know for sure. Did Gore win the election? Well, Bush got into office, and he began to roll back the Clinton era tax increases, picking up the same logic as had been made by supply side economists. lower tax rates, stimulate business, and in the end, you're going to get more revenue because the pie is going to be larger. Well, he signs the bill in 2003 that reduced tax rates on long-term capital gains and dividends down to 15%. Now, from my perspective, it should have been apparent to anyone that this increase in disposable income provided new financial fuel for speculation in real estate and stock markets. You give high-income people more disposable income. What are they going to do with it? Well, how many yachts can you have? How many mansions can you have? How many global trips can you take? And so you put the money in the hands of investment managers, and what are they going to do? They're looking for the highest yields possible. And so they're going to look around for where the best deals are in real estate and the stock markets and collectibles like artwork or expensive antique automobiles, et cetera, et cetera. Well, Bush's economic team, in my view, ignored the option of providing tax incentives for investment in actual capital goods. What that would have meant would have been a legislation that would have targeted investment to give companies a tax credit either for direct investment in capital goods creation, new plant and equipment, or what one economist named Mason Gaffney talked about in his writings is that they could have given companies an investment tax credit for every full-time employed who got benefits out of, other than the executives. And so that could have created an incentive to hire more people, even an incentive when the analysis showed it was a close call, instead of automating, actually hire people. So there's a lot of possibilities of what government policy can do to help stimulate or move decisions in one way or another based on what the policy objectives are for the administration. But as it turned out, there were some serious problems because the conservative ideology of the Bush administration resulted in a couple things that were pretty devastating to the general public. One was passage of the Bankruptcy Abuse Prevention and Consumer Protection Act in 2005. This made it much more difficult for individuals to use bankruptcy to get out from under their debt. Their one option would be to take equity out of their homes in order to raise cash. And many people did that, used the equity they had in the residential property to take out debt consolidation loans, that kind of thing. For those that already had difficulty maintaining a good credit rating, there was really no option but to go into the subprime mortgage market. And here they would have been able to do debt consolidation perhaps, but at very high rates of interest. By 2005 and 2006, because of all this, the subprime lenders now had 20% of the mortgage loan market. That meant 1 out of 5 loans was being made at a much higher rate of interest, often characterized by heavy fees, predatory conditions, and more frequently by outright misrepresentation and fraud. So what was happening in the markets was really moving toward a period of serious instability. And so this is only 2 years before the crash when this is all taking place. And still not very many analysts were observing the risk. You can see by the chart with regard to the subprime share of the market, how it climbs in 2004, 2005, and 2006. Any questions so far?
Do you have any question?
I heard somebody say something, but I don't think it was that. All right, then I'll go on, but stop me, raise your yellow hand if you have a question or you want to make a comment. So this next chart shows you what happened with defaults. And the default rate on subprime mortgage loans was considerably higher than on what would be called conventional lending. Defaults skyrocketed, and when the property market cycle began its inevitable downturn at the end of 2006, we saw an increase in foreclosure-related losses resulting, as indicated by this chart. The general statistic is this. What's called a loan-to-value ratio exists on every loan, and that is the principal balance of the loan against the current market value. What's that loan-to-value ratio? Well, in the event of a foreclosure, if that loan-to-value ratio is above 70%, the investor is going to lose money every time. The accrued interest on a loan that's not being paid just climbs. Generally, there's a good deal of disinvestment in the property. People don't maintain it. Some people in the property, just before the eviction, they may take it out on the property and do all kinds of damage. So when that property goes into the portfolio of an investor and they have to go in and try to fix it up, the costs climb, and it's very difficult to resell that property and get out from under. So a lot more loan losses are climbing during this period as each incidence of foreclosure occurs. Now, a lot of these mortgage loans in the subprime market, as well as the conventional market, they're put into mortgage-backed securities. And many large financial institutions, governments invest in these mortgage-backed securities. The default rate increases on the underlying collateral. That means the value of the bonds, the mortgage-backed security, starts to fall. So in particular, the value of the mortgage-backed securities issued by the banks, what are called private label MBS, they really began to plummet because the loans that collateralized those securities were often characterized by a lot of really bad underwriting and outright fraud. And so if you want to put a direct cause on the financial panic that occurred, it's now. I'm not sure what's going on. So I hear someone talking, but I can't tell if I'm being asked a question or comments being made.
It's okay. It was Yanni. I took care of it.
Okay. Well, here's the next chart I'm going to show you. It really indicates that the US government has, for all the post-Second World War era, spent in excess of revenue. I mean, it's not much at the beginning, but when you begin looking at the era of the US involvement in Southeast Asian wars, then it just continues to climb. So the level of public debt's increased at an increasing rate, and that is increased the greatest since the passage of the Reagan-Bush tax cuts on capital gains and on high marginal incomes. With each passing year, then the challenge is how to raise the revenue to service the public debt, not just pay for defense and for social welfare programs, but depending upon the rate of interest, you have to now tax the public, tax businesses and individuals at a rate that's sufficient to actually raise the revenue to pay for the public debt. And so that's just a chart that indicates, even during the robust times of the Clinton administration, there's not much of a leveling off there. Now, as the global economy was struggling to emerge from the 2008 financial crisis, there's an almost endless list of analysts who offered their interpretation of what happened and why it happened. And they sold a lot of books. I wish I had written one. I didn't, but maybe if I had, I'd be retired in a real comfortable financial situation. One of the most important, in my view, was published in 2010 by the Council on Foreign Relations. And the author of this book his name was Sebastian Mallaby. And the title of the book is More Money Than God. Has anyone read this book? Well, if you haven't, either get it on eBay or go to the library and pick up a copy, because it's definitely worth reading. It has a lot of details in it that I can't provide, in this lecture. Well, what Malaby describes in remarkable detail are the circumstances that stimulated the creation of hedge funds as major players and speculators in the financial markets, and their enormous gains and corresponding losses and collapses. So you have this process where some very smart people thought they had come up with algorithms that would allow them to invest using hedge fund assets and always outsmart the markets. Basically, the problem with that is, as long as you're the only one who's doing it, and you're the only one who's using those algorithms, yes, you're going to be successful. But what if all of your competitors are using basically the same algorithms? So now the advantage you had in that market is gone. So Malaby explains in clear language the power and the privileges acquired by the global investment and commercial banks in this whole situation. And what distinguishes the book from many others, I think, is its exploration of what motivates individuals to act as we do in pursuit of financial gain, and to try to gain power on how to direct markets. And he describes the frenzy of the mid 2000s in this way. He writes, volatility was low because the world was awash with wild money, but abundant liquidity was giving the false sense that stability was due to some magical structural improvement in the financial system. Investors from Asia to Arabia were wiring billions of dollars to fund managers in New York, buying every piece of paper that Wall Street's mortgage desks could sell. And so you pump all of that money into asset acquisition. Supply and demand means, well, they're going to create more assets, new and strange sorts of financial instruments to invest in, but the prices are going to be driven up by the whole process of supply and demand. Giannis, you have a question, comment? I see your hand up. You have to unmute yourself. No. Okay. Well, I'll come back to you when you're able.
No.
Oh.
Now I did. I need to be. In any case, two comments. First of all, I think the term investor is not proper, because these people do not vest in the properties they buy, or even, and that applies to the entire field of finance. There is no investing in finance, because you vest in something that has not been produced. And it's a wrong term to call it that capitalism, because capital is something tangible that has been created, and future production is not. So all these people are rent investors. That's my first comment.
Let me first interrupt you and say I agree with you. Of course, I mean, it's a question of if it's a gambling casino and you're putting money in the gambling casino, are you investing or are you simply speculating? And the question is, do you have sufficient knowledge of how the casino works to outsmart everyone else who's putting their money in the same gambling casino?
Absolutely, and that takes me to my second point, which is to your comment about algorithms. Actually, this is not the algorithms, and it's not. They're not meant to be proprietary. Sure, there is proprietary knowledge, but actually the game is the opposite. You want everybody to follow that algorithm, because that actually creates creates the casino. If I go to the casino and we don't have the same algorithm for the blackjack game, for example, or how the roulette, or how for Texas Hold'em, for poker, there's not going to be a game. So actually the algorithms are, and that's the role of the academia, wants to sell them as academic, as mathematical, as robust, so that the market can play into, and then all the money can pour into this casino game.
Well, my only comment about that is, generally speaking, if you're smart enough to come up with a analytical approach that's unique to all other analytical approaches, you might be maybe you might be able to outsmart your competitors, outsmart the market for a while. But eventually they're going to figure out the game, and there are going to be more entrants into the game with the same tools. And so in order for you to then keep winning or not lose, you're going to have to come up with a new tool, some other new tool. And that's where the analysis of property market cycles comes into play. And right now, I have, some of you know Phil Anderson, who's a colleague of mine, and he runs an investment advisory service out of Australia, and he's done a tremendous job in merging the cycles of the equities and bond markets along with property markets, so that he can advise his quote investors on when it's the right time to be in what market and out of what market. And if Phil's observations are that these cycles repeat, and under current socio-political arrangements, under current tax laws, under current public policies, they will keep repeating. And we will continue to have these cycles so long as we do not change our system of taxation and law, so that we remove the potential to profit from rent seeking and from what Fred Harrison has called the free rider cheating. So there are plenty of people who are looking at how the system works. A few of them, like Phil, are also saying, hey, the system works for some, but not for the many, and therefore it needs to be reformed. I'll tell you how it works, and I'll tell you how to be successful with your asset investments, but I also want you to understand that this game is rigged. And that's what he adds to the discussion. His book is still worth reading. The Secret Life of Real Estate came out about 10 years ago. But if you haven't read it, I don't know if you've read it, Giannis, but if others might not have known about the book, it's worth reading. And if you do put money in asset acquisitions that we've been talking about, it's not a bad place to start. Not that we're this course or our discussion about how to get rich, but in the process of explaining how things work, Phil's book will tell you how to possibly make money yourself if you're inclined to do so. So, well, getting back to the story, the widespread fraud that characterized the subprime mortgage business became apparent when many investors, when many borrowers failed to meet even their first payment on their loans. This is an amazing thing when you can think about it, that loans were closed and no payment was ever made on the loans. In the most fraudulent instance, the mortgage broker or originator that made the loan would make the first payment or two to make the loan look legitimate. Now, they would have gotten the money to do that based on the fees they charged to the borrower who was complicit. Well, the first very large domino that collapsed was explained by Malaby in the book. He writes this: rather than running their books in a way that rigorous analysis suggests would be safe, banks sometimes run their books in a way that the capital requirements deem to be safe, even when it isn't. Hang on, there's more. Subprime mortgages presented a classic example of this problem. Bonds backed by toxic mortgages were given the top AAA rating, partly because the rating agencies were paid by the bond issuers, which dulled the incentive to be critical. it's worse than that, that the rating agencies had no trained staff to evaluate whether or not these mortgage loans were properly underwritten, prudently underwritten. And finally, Mallaby says, once the AAA seal of approval was affixed to subprime assets, banks were happy to hold them because capital requirements allowed them to do so without putting aside much capital. Regulation and rating agencies thus became a substitute for analysis of the real risks in mortgage bonds. And it really created the scenario for us for an amazing financial crisis. I have to say, 40 years in the banking sector and as a residential mortgage lender, that part of the economy has always been fraught with fraud and misrepresentation and a lot of criminal activity. I used to get calls from real estate appraisers who were hired to do an appraisal on a property, and they were given a number, and the mortgage company said, "We need you to come into this number." Appraiser would call me when I was at Fannie Mae and say, "Ed, this, I can't come up with this number. What should I do?" And my answer to him was, well, two things. One is, I'm not your regulator, so I can't tell you what to do. I'm not a government agent. But you called me and you've told me now that you're pressured to falsify appraisal reports. So I have to put your name in my computer so that any appraisal report that you do that shows up in our system, I will pull that file and I will check it to see if it's accurate. So I said, I don't know what to tell you to do, but if you want to preserve your integrity, you've got to turn down the job or suffer the potential consequence. So there are a lot of people put in the middle, their income is at risk, their financial health is at risk, and they're getting pressure from people who want every deal to go through because it's money in their pockets. It's one heck of a system, but that's the way the market runs. Well, Giannis, you got another comment?
Yes, I have a question, Ed. I don't want you to go into detail about the appraising business, but from your experience, is this appraising factoring in future expected cash flows, or is it based on the, let's say, the development cost, the maintenance cost that currently that property or that property has incurred since each let's say
I'm not
creation?
okay. I'm not 100% sure I understand your question, but are you really asking me how does an appraiser establish the value of a property?
Yes, and whether that includes future cash flows or current expenditures that have been put into
okay. Without taking a lot of time, just a quick explanation. The appraiser is supposed to evaluate a property based on three ways. One is the replacement cost, how much it costs to replace this property, and then factor in the depreciation. The second way is to get comparable sales. In other words, find properties that are as close as possible to the physical description of the subject property in the same neighborhood, if possible, and then make adjustments to the value that are based on a number of critical factors. One important one being site location. So for example, you could have two houses identical on the same street, but one has a corner lot and another one does not. The corner lot would probably be more valuable in that market. And there are other similar factors. So there's also the third, which is the income valuation. In other words, if this property were owned by an investor, what rental income would the property yield? And so you have to get comparable rental figures for that property. And when they put that all together and they give you their best estimate, and most appraisers would admit, that, hey, What I'm asked to do is not justify what a given buyer paid for the property, but what the next potential buyer would be willing to pay for the property based on all these other factors. So that's the job of the appraiser. And if they do their job right, you can pretty much, it'll be in the ballpark. So I hope that gives you a satisfactory answer to your question. Oh, well, so a real fundamental question about all this is whether that portion of the economy that's engaged in financial transactions really adds to the production of actual wealth or merely results in its redistribution. Is there a loser for every winner? The public has come to see that there are few winners and many losers. So that's part of the whole equation that we have to deal with, and the public policy changes in the United States and in other countries all have a major impact on who gets what. Who are the winners and who are the losers in these scenarios. Well, since the 2008 crash has occurred, a small group of economists and financial reformers have been working to try to stimulate meaningful debate over whether the issuance of currency should be made the responsibility of government, should be fully privatized as in the era of free banking, or that the whole thing just simply requires more rigorous regulatory oversight. That the system's pretty good, but we went too far in terms of deregulation, and so we have to re-regulate the system and bring back stronger regulatory oversight. So what I'm going to cover now are some of the reform ideas that have been put forward over the last couple of decades, actually. And the first person I'm going to talk about is Stephen Zarlenga, who founded the American Monetary Institute in 1996.
Over 20 years.
He did extensive research on the history of money and banking and credit, authored a book on the history of money. And in 2004, he gave a speech where he placed much of the problem on our financial system on the economics discipline. He said this about it: "One reason economists have failed mankind so badly is their poor methodology and over-reliance on theoretical reasoning. Alexander Del Mar, the world's greatest monetary historian, noted, quote, as a rule, economists don't take the trouble to study the history of money. It is much easier to imagine it and to deduce the principles of this imaginary knowledge." That's been a growing criticism of economics as a discipline generally, that the world that they describe in the economics textbooks is a world that doesn't exist. And so they're trying to offer public policies that would be appropriate to the world they created, but aren't necessarily appropriate or useful to the world that we live in. So Zarlenga offered several solutions to the problem. He went on to say that we should, number one, nationalize the Federal Reserve System, reconstitute the Fed within the US Treasury to eventually evolve into a fourth branch of government on a par with the executive, judicial, and legislative branches. And C, only our government could create money, which meant taking that power away from the Federal Reserve System and, incidentally, from commercial banks. One of the mysteries of our commercial banks that modern monetary theorists or analysts have put forward is that the law permits commercial banks to create money. And I've had a lot of difficulty with accepting that analysis, but I have finally succumbed to accepting that it's probably true. And I have tried without success to get anyone in the banking community in a controller level position to explain to me exactly how a bank can in fact make a loan without having cash on hand to make the loan, and what those accounting entries would be. I've looked at several accounting texts. My wife teaches accounting, and I've looked through the 800-page text and cannot find any explanation for how this is done. So if anyone here in this course has a good source that can confirm the accounting entries of how a commercial bank can actually make a loan and book that loan without having the cash to do so, acquired either from depositors or from borrowing or from issuing stock, whatever, I'd love to have that information, because I can't get it from any of the institutions that ought to be responding to that question. Well, so that's Steven Zarlenga and the American Monetary Institute, what he would like to do. At the opposite end of the reform spectrum is the proposal to once again permit, quote, free banking. Under free banking, any banking entity could issue its own banknotes. Market forces would be relied on to control the supply of banknotes and the quantity of reserves required to meet the demands for cash by depositors. Reserves, they argue, would have to be in the form of gold, silver, or possibly other scarce commodities with a stable value. My particular preference is bricks, construction bricks. And I think I might have mentioned that last week as to why I think construction bricks would be a good option. But they basically would, think it's a good idea. And one of the stalwart supporters of free banking is an economist that some of us know pretty well, a friend of mine. His name is Fred Foldvari. He, for many years, has taught economics at San Jose State University, and he strongly believes that free banking would work very efficiently and with little corruption. And the reason he says that is common sense in a sense. He writes, "The artificial increase in money supply can be halted permanently by implementing free banking. Without a central bank and a national currency imposed on the economy, inflation of the money supply beyond the growth of the economy is no longer feasible, since there is no longer a monopoly of the money supply." And the other statement on behalf of free banking is, no one would be forced to accept the banknotes issued by that bank, because they would not be legal tender, in the sense of you couldn't use those banknotes necessarily to pay your taxes. People would have to voluntarily accept them in exchange for goods and services. So those are some of the arguments for a return to free banking. Another approach was taken by an advocate of social justice by the name of Norman Kurland. He's an attorney. He was a longtime collaborator with Louis Kelso. Some of you may know Kelso as the architect, the sort of leading spokesperson on behalf of employee stock ownership plans. So that was Kelso's role, and he and Norman Kurland worked together. Kurland founded the Center for Economic and Social Justice. Dave, I see you have your hand up. You have to unmute yourself. No. Okay, I see.
I think you guys are unmuted me. Could you please explain the Fred's scenario one more time? I know I'm going to drag everybody back, but please do that.
Explain the what?
What Fred Foldvari said.
Okay. Fred Foldvari said we should not have a central bank.
Yeah.
That every community, every state could be free to start to charter their own banks. And each bank would have the authority to issue their own bank notes. Those bank notes would be used to make loans put those banknotes as money in the hands of their customers. And their customers would then use those banknotes to buy additional goods and services from people in their community, or if people who live further away from their community accepted them, they would circulate as money. But no one would be required to accept them. So if someone said to you, Dave, I'd like to hire you to do a job for me, and will you accept the banknotes from the first community bank of my town? And you would say, no, I don't know that bank. I'm not accepting those banknotes. And so that customer would go away, or that job would go away because you were unwilling to accept those banknotes. Is that clear enough? I'll have to say it is, because you're not responding.
Yes.
Okay.
Look like it's getting unmuted by you guys.
Okay.
So yes, I will say yeah, that's clear now.
Okay. Giannis, you want to jump in again?
Yes, Ed, since we went back to the free banking policy, I have a question. It's kind of historical. Didn't the US have that system in the late 19th century, and then it went haywire? Municipalities were issuing their own money, states, it was like a big mess. And that big mess is what led to the creation of the Fed, in order to put order into the chaos.
Well,
can you comment on the pre-Fed history of the United States?
Well, I covered that last week, so I don't want to go back over all that material. The answer is not all bankers are honest, but most were. And so historians basically now say, that yes, there were problems with free banking, but the problems were no worse than when we had national banks and when we had a de facto central bank. So you have to make your own judgments about what would happen today under this system, because obviously everything is done electronically now. So you would have exchange rates between hundreds of banknotes serving as currency. Could it be done? Would it be efficient? We have communities now that issue local currencies. There are local currency networks all across the United States and in Canada and many other countries, where these local currencies circulate in the community, mostly because those communities are cash poor. In other words, they don't have the Federal Reserve notes to circulate in their economy, because the goods that they're buying are all produced somewhere else. And so when they go to Walmart to buy their stuff, the money goes not to the local merchants to circulate in the community, but goes back to Arkansas and to the Walmart executives, kind of thing. So we have experiments going on with currencies that are designed to circulate in the local community. Free banking is based pretty much on that concept, but now you have the added complexity of global global commerce, and you'd have to have a fairly extensive time sensitive system that would automatically adjust the exchange rates. And you'd have to have, in my view, you would have to have two things occurring. One is very sound auditing, and number two, a private insurance protection for depositors. So those are some of the conditions I think are needed to make the system work.
And what about taxes? First of all, I don't believe if you have taxes that would work. Like unless these local currencies could pay taxes, I don't think they would be workable in the sense.
Yeah, that's a fair comment, and I don't have an answer for you because we don't have a best practice experiment to use to make judgments. So maybe, maybe we'll eventually get that sort of legislation that would permit some community to do that. Michael has a hand up. Mike, you want to unmute yourself?
Okay, all right. I think you should be able to hear me now.
Can hear you.
Yes, okay. So Ed, you mentioned before to Yanni about how your friend had said that that free banking could exist. Wasn't that just the way it was, like in the late 1800s, before they had all these bank runs and then had to turn things over to the Fed?
Yeah, well, that was Giannis's observation, but you have to go back. Last week, I gave you a pretty specific, detailed history of how it went back and forth.
Mhm.
You start out with people very much wanting a central bank. You have Andrew Jackson totally opposed to it and puts all of the federal money in state banks. Then, that system grows. The national banks respond, and then the state banks respond. We get checking services. We get, then we get the Civil War and greenback money, and then new national bank legislation. Then you have after the Civil War, there's a lot more, chaos, because after the Civil War is when the West really starts to get populated. The battle's over bimetallism between gold and silver. Finally, you have the 1873 financial crisis, and then the 1907 crash, and eventually you get the Federal Reserve. So it's a very involved story, and we're still struggling, and that's what I'm going through now. We're still struggling to determine if what we have ended up with is the best we can do, or is there something much better than what we have? And if there is something much better, how can we get there?
Okay, so can I interject one more question?
Sure.
Yes. Okay, so that being said, thank you for that quick summation. And I actually did follow it. I didn't make it fast last week, but I got the idea.
Okay.
And so in other words, it was the best that could be done at the time. But, it still holds the most promise, is what you're saying. Now,
I don't know that. No, I don't. I'm not going to go that far.
Okay. All right.
I'm saying there are some positives to free banking, and there are some concerns that have to be addressed. And my two concerns are rigid auditing and insurance protection.
Okay. I just wanted to posit that as a possibility. But the other thing is, I wanted to ask you about the German banking system. And I know there, because I lived there at one time and I was working there. This was back in the 70s, and I was getting direct deposits to my account because I was working for Opera House there, and that was considered like a civil service job. But I know that those banks, the Sparkassas, which is like the local bank, the depository bank, like their banks are chartered just to help out people within that community. Like they can't have a friend from outside another community that comes and gets a cheap loan from them. They are specifically mandated to help develop that community. And that's their whole system of public banking. And that seems to work. And it's worked there for a while. And the rest of the countries in the EU, they want in the banking system Germany. They want them to change that.
Yeah, well, we had that system in the United States for most of the 20th century. That's what savings institutions have been designed to do. And we do have community banks now that are focused on that. But we've had such a long period of deregulation and mergers and consolidation that it's made it very difficult for those small community banks to be very competitive. But they found niche markets. They found a way to survive by serving the communities of small business people, for example. I mean, Wells Fargo may say they have a small business lending program, but if you went into Wells Fargo office and wanted to borrow less than $10 million, they'd probably say, we just can't help you. I don't know what the number would be, but they would send you or you would go to somewhere locally. But our system has moved very much away from that. But there are still, I forget what the minimum amount. I think you have to have in the United States $20 million in assets to open up a bank. But there are banks being opened up all the time, and there are banks that are being opened in communities that were traditionally and are continue to be underserved. So if you wanted to open up a bank, go to an inner city neighborhood, and you probably can, find a market to open up a community bank. Now, whether or not your charter is going to restrict you in geography, I don't know if that's a state charter might. I don't know if you tried to become a national bank, if you would be having a restriction, because now you can go, across state lines without any real restriction. But putting the genie back in the bottle, it's possible. but Wells Fargo and a handful of other banks have a lot of lobbyists in Washington.
Yeah,
American Bankers Association. I think I said this last week, but I'll repeat it. When I started at Fannie Mae in 1984, 80% of our business came from about 250 different lending institutions. When I retired in 2005, 80% of our business came from 8 financial institutions.
Wow.
And half of them weren't even domiciled in the United States.
Yeah.
So that's what happened in that 20-year period when I was there.
No, it's the same in Germany. They have a huge number of banks in different locations, but they're disappearing. But it's based on the hypothesis that pretty much works, that if you're just in a local community and the people there, they know who you are, it's very hard to make a bad loan.
Well, the other side of that is, if you can, join a credit union, because the credit unions are much more focused on serving their local communities and their members. And so their executives aren't being paid $1 billion a year. So I'll put a plug in for credit unions. Join a credit union if you can.
There was one that was here in New York, and they bet on the wrong horse. They bet on those taxi medallions when they were way up there and cost $1 million.
Yeah.
And they didn't get out of them quick enough.
Well, yeah. Hey, look, if I often ask this question, if it's true that commercial banks, and I'm going to exclude credit unions, if commercial banks can create money out of nothing by making a loan, how was it possible that so many banks still became insolvent and went out of business? So there's some technical issues that I haven't been able to fully come to terms with. And I had a long conversation on the telephone with a couple of analysts at the financial FASB, Financial Accounting Services Board, Systems Board, whatever, FASB. I can't remember what, but anyway, about 2 years ago, I got them on the phone for an hour and a half, and went over. I tried to get them to explain to me what the regulations were that allowed this to happen, and they, in fact, couldn't explain it. So someone with a better investigative journalistic niche than I have, maybe you can finally resolve this with regard to the United States.
Well, I have heard about FASB before, but I've heard it in the context of some of these interviews with Catherine Austin Fitts.
Yeah.
And she talks about how it was used basically to take out money. In other words, that was like the secret box that you could put money in and it would just disappear. And
well, FASB's basic responsibility is to come up with accounting rules. And when all these strange financial instruments were created, they were supposed to look at them and say, okay, what's the level of risk? How do we account for these? When does an institution have to take a loss or declare a profit? How do you mark these assets to market value? So just in the same way that the bond rating agencies were not adept at pricing for the risk of subprime mortgage loans, I wonder if FASB has had the level of expertise to do what the new financial markets required. Let me go on with some of this other
thank
stuff.
you very much, Ed.
You're welcome. Now, getting back to Norman Curlin, I had a chance to talk to him a couple of times years ago. What he and his allies sought was a society where every person derives some income from owning the shares of stock. So in his scheme, we would become a true capitalist society. And a capitalist society would be defined as we all get a significant portion of our income from owning shares of stock. Not as Giannis, talked about tangible capital goods, buildings, machinery, et cetera. But that was Curlin's situation. And they fought for passage of what was called the Capital Homestead Act. And here's what he said about it. The Capital Homestead Act's central focus is the democratization of capital, productive credit. By universalizing citizen access to direct capital ownership through access to interest-free productive credit, it would close the power and opportunity gap between today's haves and have-nots without taking away property from today's owners. It was their way of using credit as a way for people who didn't have the cash to buy shares of stock to gain those shares of stock, and then the money that was used to buy it would be repaid out of the gains. It's kind of, it's like if you work for a company and they have a stock offering and you're an employee who's eligible, you can do it sometimes by what's called the cashless offering. In other words, you buy the stock at some stated percentage of its current market value, say 85%. And then you use the difference to pay off the amount. So you get the stock at 85% of the market value, and you then sell the number of shares of stock that's necessary to pay for it. Only you're selling the stock at 100% of market value. So that's why they call it the cashless exercise. So if you're eligible to buy 300 shares of stock, maybe you get to keep 75 shares out of the 300 for nothing. And that's how he thought slowly but surely everyone who works for a company that issues shares of stock could become a capitalist. It doesn't account for all the people who don't work for a company that issues shares of stock, but that was his basic idea. Now, out of all of this, a lot of change has developed, of course, all this pushing for different types of legislation. So in October of 2008, George Bush is still in office. He signs what's called the Emergency Economic Stabilization Act. And this is when the $700 billion is made available to the Treasury to acquire troubled assets, which were primarily bank shares and mortgage-backed securities that were losing value. So the list of companies that were helped or bailed out included AIG, Bank of America, Citigroup, JP Morgan, General Motors, and other companies. And they got about $427 billion. Now, you can criticize that, but all of it was eventually recovered, and the government got a $15 billion profit in the deal. So was it a good investment? Well, maybe so, but was it a lost opportunity? Well, the lost opportunity was, should maybe some of these companies, the banks, should they have been made a public utility out of that process? In other words, they were technically in deep trouble, insolvent. The government did bail them out, and they were given a chance to soar back to profitability. Their executives were given the opportunity to pay themselves huge bonuses in the process. Well, this was a lost opportunity maybe for government takeover. My former firm, Fannie Mae, was taken over without a whole lot of fanfare either. The circumstances were a little different, but the government felt perfectly confident in putting Fannie Mae into conservatorship, and it has remained there ever since. There's a lot of the discussion going on right now whether Fannie Mae should be returned to private control, but I don't know when that's going to happen. I held on to all my stock. It's worth $1 or so a share. Maybe before my time on this planet is over, the stock will come back a little bit. But that's what basically happened. So what did economists have to say about it? Well, in 2008, the president of the United Nations General Assembly convened an international panel of experts. Was chaired by the economist Joe Stiglitz, and they are charged with analyzing the causes of the crisis and offering measures to try to stabilize the global economy. And late in 2009, the Stiglitz report was released, and their conclusion is summarized by the next two slides. He writes, or they write, the crisis is not just a once in a century accident, something that just happened to the economy, something that could not be anticipated, let alone avoided. We believe that, to the contrary, the crisis is man-made. It was the result of mistakes by the private sector and misguided and failed policies to the public. Reforms over the past 3 decades have exposed countries to greater instability and reduced the impact of automatic stabilizers. The crisis is in part a result of excessive deregulation of financial markets. Restoring the global economy to health will require restoring to the state the appropriate role of regulator of financial markets. So Stiglitz comes down, and this whole group comes down on the side of, well, the system has its problems, but we think it's essentially sound. We just need to become, the government has to become a better regulator, and we need better laws to control the outliers, the people that take these excessive risks, even though the risk is passed on to their, Giannis quote, investors. And they thought that the things would get better. Well, so we get in the United States the most important legislative response passed in July of 2010, and that's the Dodd-Frank Act. And this attempted to set more rigorous standards in the securities and financial trading markets. A key feature involved improved regulation of credit rating agencies and the asset-backed securitization process. And to tell you the truth, I don't know how well that is going. There was a new council that was comprised of staff from the Treasury, the Federal Reserve, and many other government bodies appointed to monitor the nation's largest financial institutions. This body was empowered to take action if any institution presented a risk to economic stability. So, increasing the risk-based capital requirements is an important part of the protections, to be sure. But the question is, are these financial institutions going back to prudent lending? And there are all sorts of issues with this, because sometimes government wants the banks to put money out in the public, in the market, for certain specific issues, and the bankers probably would not do it unless they were given some sort of subsidy or government protection. So we have sometimes a conflict between what is prudent from a lending practice standard and what the public sector wants to accomplish in terms of public policy. And that has to always be taken into consideration. Well, analyzing the financial structure of all this, an attorney named Ellen Brown began to write in support of establishing a nationwide system of public banks that would be modeled on the Bank of North Dakota. If you remember the story of the Bank of North Dakota, created in the early 20th century and still going strong, and is a model of success in North Dakota. Her first book on the subject was titled Web of Debt: The Shocking Truth About Our Money System and How We Can Break Free. That was published in 2007. And in 2011, she founded the Public Banking Institute. The Henry George School has had her on as a co-speaker in a recent webinar that was done. So she discussed a lot of the progress that's being made around the country, where there is increasing amount of interest, not only at the state level, but at the city level, for establishing public banks, who would basically have a much stronger obligation and responsibility to see to it that spending was done effectively for infrastructure and in the public good in their jurisdictions, which the commercial banks really do not have such a mandate. Well, Ellen Brown has since written 2 more books on the subject. In March of 2021, she reported on the progress of getting legislation established. She wrote, just over 2 months into the new year, 2021, has already seen a flurry of public banking activity. 16 new bills to form publicly owned banks or facilitate their formation were introduced in 8 US states in January and February. 2 bills for a state-owned bank were introduced in New Mexico, 2 in Massachusetts, 2 in New York, 1 each in Oregon and Hawaii. And Washington State's public bank bill was reintroduced as a substitution. Bills for city-owned banks were introduced in Philadelphia and San Francisco, and bills facilitating the formation of public banks or for a feasibility study were introduced in New York, Oregon, 3 bills, and Hawaii. So this is a big deal, and it's starting to really accelerate among public officials and communities. Alec, I see your hand up. Unmute, yeah, unmute yourself, Alec.
Let's see. Oh, there. In Colorado, that's what we've been attempting for the past 5 years, both a state and also a city public bank. And even with liberals, they are really, I don't think it's a matter of convincing them that it will work, is that even with educating them, they still don't go forward with it. It's as if they need to be pushed, nudged, etc., by a social movement rather than be educated. Education is necessary but not sufficient. You can educate and people will still object to taking up the legislation and passing it.
Well, my comment would be, I suspect that there are plenty of American Banker Association lobbyists in the capital of Denver,
Yes.
in its halls, arguing against this legislation in some other way, and maybe subtly saying, you know, we gave you $10,000 in your last campaign. You know.
Yes, right. No, I think that that's exactly it. And actually, the 2 banking associations in Colorado have written to all the legislators a letter as to why we should not have public banking. And we responded publicly to all 4 points that they make, which are either mistakes or lies.
Yeah.
Right?
Well, I'm not surprised. that, I mean, but there is momentum here,
Yes,
and, you know, hopefully there will be enough of a public outcry, a demand for this change to occur. So we'll stay
That's-
tuned.
yeah, that's what we're attempting, is to create a social movement to say to senators and representatives, hey, listen, either you pass that or take up the bill and pass it, or you're out of office.
There you go.
So you choose.
Well, I mean,
Thank you.
many good ideas are opposed by the politics that exist. And so you have to somewhat change the politics, and people united behind a cause can do that. Of course, you know, people can also unite around terrible causes, as has occurred from time to time. And even in our recent years, we've seen that. So hopefully wisdom and logic will prevail, and education can help that. I wish the people of Colorado success in getting the bill passed, and everywhere else.
Yeah,
Well, so in this whole scenario, when you think internationally, you know, one of the things that we have to remember, that there are still many structural problems that have not been solved. You know, when you take a look at the European Union, for example, they tried to create a single monetary and banking system, but they did it without having sufficient influence over systems of taxation or even of the budgeting of member states. So they ended up with countries like Portugal and Italy and Ireland, Greece and Spain that had to be had to have their financial systems intervened and protected by the European Central Bank and the IMF. Well, and what does the IMF do when it intervenes? The IMF's basic plan is austerity, raise taxes and stop spending. And so, you know, the European Union has a lot of issues to deal with. And now Britain's withdrawal will certainly have a lot of consequences that are not yet fully understood. We won't really know for sure exactly what's going to happen until it actually occurs, because it hasn't been done before. Well, the World Bank has looked at a lot of this. A global financial development report they issued in 2019 concluded that while large banks had shifted their assets into categories that have lower risk weights, there are surely hidden risks, so that the numbers may be providing a false sense of security. So this is another part of the issue. Just like when we were talking about, you know, property appraisals, if you don't appraise a risk accurately, if there are unknowns about that risk that could bite you in the back, then you're still exposed. And what systemic protections will there be? So this is why I say with free banking, you know, I would want to see a really good auditing system established, as well as private insurance protection, because insurance carriers, one of the things they're really good at when they do their job is pricing for risk. And so we need a lot of attention to those details. Now, the Trump administration decided that it was not in the interests of the people they thought they should protect to enforce the Dodd-Frank provisions. And so in 2018, he and the Republicans passed the Economic Growth, Regulatory Relief, and Consumer Protection Act, which, in my view, did none of those things, but removed for many of the regulatory requirements for the banks if they had assets below $250 million. So leaving the banks up to themselves, hopefully the bankers learn some lessons. We will see. We haven't seen any real bank failures of late, but that could happen again if we go through another recessionary downturn. So here's a chart that just shows the ownership of US debt. And why did I put this up here? Well, because many nations have been pulled into uncharted financial territory, and none so more than the United States. The law governing the Federal Reserve permits the central bank to create monetary balances at will, balances that are then loaned to the federal government. If the government securities are sold to investors, there's no increase in the net money supply, merely a shift from private to public spending. Okay, so the other alternative is if the securities are held by the Federal Reserve, the money supply is expanded until the securities are finally sold and the money comes back to the Fed and they hold on to it. So, all of that factors into who owns the debt. Is it owned by the Fed? Is it owned by individuals? Is it owned by corporate entities, by the banks, by foreign countries? And it's only when the debt is held by the Fed that we could possibly have the debt repudiated. In other words, the Fed could possibly agree to simply write it all off. And that's one possibility that has to be considered. So at the moment, it's unlikely that the US public debt would ever be paid off. And so I just mentioned this as one possibility of reducing the national debt without having a detrimental impact on the government or the economy. Now, here's where we are about now, 27 trillion. And since the debt comes from monetary balances created out of thin air, this is why I say the Federal Reserve could simply cancel the debt that they hold as an asset. They have it on their books as an asset. They could just write it off. Economists would have to look more closely at what the implications would be. But in my view, that's one of the options that needs to be considered if we're ever going to get the public debt reduced. Now, here's this chart that just kind of shows this, the cycle of how this all works. The Federal Reserve could, as their securities matured, they could create enough new money to go out into the credit markets and purchase all the government securities that are put on the market by private holders of debt. So you could get rid of the debt that's in private hands simply by creating more money out of thin air and using it to buy that debt. This would expand the money supply by putting cash in the hands of the people who now hold government securities. What would they do with the cash? Well, they would deposit in the banks to be recycled, to be invested in corporate shares or invested in corporate or non-federal government bonds, or just spent on consumption. But if we think about where we are in the economy right now, and there is a shortage of cash in the hands of consumers and those who will spend on goods to create employment, then there are two ways of simply handling this. One is to simply, give the government the authority to spend the money in the circulation, which would do nothing about the outstanding debt, or let the Federal Reserve issue new Federal Reserve notes, or the US government could issue treasury notes and use those notes to buy out all of the outstanding debt that exists, or a good portion of it. So we'd be able to pay down the debt considerably and put money into the economy. What most economists would then ask is, well, is this going to create inflation? The standard, or one definition of inflation, is too much money chasing too few goods. But that doesn't seem to be our problem. We have, goods to spare that aren't being consumed. So I don't know what would happen exactly, but it's my view that it's probably something that needs to be looked at as part of the reform in our monetary system right now. So there's a small group of economists who argue there's no reason why governments must incur debt in order to raise revenue. Again, their view is that we can just create the money, government can create the money and spend it directly into the economy. Should they spend it on infrastructure? Should they spend it to give every citizen an income supplement? How should it be put into the economy? Again, that's something that has pros and cons that would have to be looked at. But there is a great argument for ending the Federal Reserve's capacity to simply print money and then use it to purchase government securities, which they then charge the government interest on. And you may not know this, but most of the profit of the Fed does go back to the U.S. Treasury. I think it's 5 or 6% that they have a maximum profit every year. Anything above that goes back to the Treasury. So it's almost like a lot of the interest payments that the government is paying on government debt, if it's paid to the Federal Reserve on government securities held by the Fed, will come back. And then the Fed makes income on fees it charges to member banks and other services it performs, check clearing services and all that. And a lot of that money does come back to the U.S. Treasury. Giannis? Unmute yourself, my friend.
Yes. Now, I have a comment on the inflation. I think it's false that we don't have inflation. Nominal prices may not have gone up, but that doesn't mean that we don't have inflation. And what do I mean? Like, you go, most of the businesses have replaced their workers. For example, if you go to the grocery store, they replaced basically all but 1 or 2 cashiers with automatic machines.
Yeah.
So they are saving on their labor costs. However, their prices have not gone down. That's inflation. That actually nobody is recording or reporting as such. So we should be very careful of what inflation means or doesn't mean.
Well, the answer, you're absolutely right. And so the question is, how is government measuring the increase in prices? And one of the big omissions, of course, is, as I'm sure you know, and most people in this webinar know, the valuation of land is not accurately factored into the rate of inflation. So any increase in the price of land is inflation because it's a fixed supply. So, but
yeah, I'm not referring. Yes, I understand the land problem, but this is even simpler because we've had, for example, globalization and outsourcing, right? With all this massive outsourcing, all the prices of the goods should be going way more down than they should. Instead, they've been going up by small amounts, of course, but actually we should have had deflation. But prices did not go down from this massive outsourcing the past 40 years.
yeah,
That's inflation. That's inflation masqueraded.
Well, here again, it's a complex story because if your annual income is increasing at a rate that's greater than the rate of increase in the general price level, then you're beating inflation. The problem is that portion of the population whose income is either stagnant or falling as prices are increasing. And so for them, the rate of inflation, their cost of living is rising at a rate that may be twice as high or higher than the official rate of inflation. So there's a lot of problems with how these statistics are utilized and determined. And so that's why there are alternative statistics being produced all the time. Different agencies, non-governmental agencies, try to do a realistic analysis of what the real cost of living increases are. And
as somebody had said, there is lies, dumb lies, and statistics.
well, inaccuracy versus a lie. I don't. You have to make a judgment call about what to believe whenever you read statistics. Joe, yes. You have a question? Comment? Unmute yourself.
Perfect presentation as always. I kind of like to let you finish, but
Well,
I
let
think
me interject just something.
I think you've finished this segment, and I wonder if there aren't some more alternatives in terms of addressing the debt problem. For example, if the federal, you follow Keynes, and if the debt is purchased, any tax revenue shortfall is funded by the Federal Reserve, and the governments are ensuring that all the idle resources are being used, and the taxation rates are set at the proper values, so that it's not inflationary. Then we should be operating at full employment and pretty close to a balanced budget. If that's the case, then those economists who want to see the debt shrink as a percentage of the economy would see that happen, because with this full employment, continual full employment economy, you're going to have a pretty much balanced budget. The debts will not be very large, and they'll shrink as a percentage of the economy. That's one approach I think that could be added to your list.
Well, I think, the right tax structure would certainly facilitate everything that you've talked about. How long it would take us to get there is, even if we had the correct revenue raising system and stimulus to real economic growth, is hard to predict. But we have a $27 trillion public debt right now. And so I think, what we're faced with is how might I say it? We're now at the point where the Fed is looking at the threat of inflation and saying, should we raise interest rates? So if you raise interest rates, you effectively raise, as each government security is maturing, you raise the interest expense on the newly issued security. So that's why, my suggestion would be, if I could get a congressman to listen seriously, to use the Fed to actually issue new money, or the Treasury issue new money specifically to buy the debt that's held privately, and just eliminate it, and take the risk that the new money creation would be wisely used so it wouldn't be inflationary. But that we could have another seminar that would last 3 or 4 hours just discussing that particular issue that you've raised. And there are plenty of smarter people than I am who would weigh in on how to balance all the risk and reward for those different decisions and institutional decisions.
I support what you're saying completely. I just think to get from here to there, even the conventional economists are saying, as long as R is less than G, as long as the interest rates are really low relative to the growth in the revenues, they can see in a full employment economy, they can see the debt shrinking and shrinking as a percentage of GDP. And all we need to do is to that one step, which is to get the Fed to buy, make a few changes so the Fed can buy the debt maybe more directly, and you can get to where you want to be without having this necessary paradigm shift that I eventually want to see. But I just think, just to get things done, that would be the suggestion I would add to your list.
Okay. Yeah. Boy, I want to tackle that, but I have about eight or nine more slides to go through. If you guys can hang in with me for another 10 minutes or so. Next week, I'd like to get into Henry George's analysis of money, so I can finish this reform agenda up quickly, if you'll just bear with me. Another characteristic of our money system that I point to is that banking and credit involve banks having not really to have the cash assets to make the loans that they make. This is the thing I raised earlier, and that they magically create money themselves. And so I think we need, among the regulatory reforms that we need some kind of reform that deals with this, that prevents commercial banks from making loans, booking loans without having the cash on hand to do it. They have to raise the cash either by taking in more deposits, by borrowing in the credit markets, by issuing bonds, by selling shares of stock, or selling other assets. To me, that's a fundamental reform needed in terms of banking regulation that is not present now. And so the best that I've been able to determine how banks stay solid is there's some ratio of their outstanding loans against their at-risk capital that the Federal Reserve monitors. And as long as they're within that ratio, the Fed views them as solvent and healthy. So I don't know what kind of legislation is needed, but I think in my mind, that's a fundamental reform of the banking system, whether or not we have a central bank or not. So what that means is that the banks, in my mind, should be returned to the function of being an intermediary. And if they don't have the money to lend, they get it or they don't lend. Now, one of the things that exists in the country, how do you start a bank? Well, it boils down to a couple of different steps. You find investors, they raise the cash, they buy the basic, they get the charter from the state or the federal government, whatever the amount is required. Then they establish some physical entity, or at least an online entity. They start taking in deposits. They use those deposits to make some loans. They consider selling stock, or they issue bonds. But if they're doing business legitimately, in my mind, they're doing it because they have the cash on hand to do it. And they are putting aside reserves that are based on an accurate and honest assessment of the risks that they're taking in their business program. Now, there are many sectors in our society now who are really looking at the banks as out of control. And I don't know what the level of monetary reform we can expect, but I would say this, that I think the move to create public banks will be an impetus for the commercial banks to begin to behave better, because it will present direct competition to them, and they will have to change their ways, or they will lose a lot of market share to the public banks. So right now, I think the way unless the Biden administration rolls back some of the previous deregulation reforms, I think it leaves us open, very vulnerable to another financial crisis. And the property markets are scheduled for a major downturn in 2026. The low interest rates have been capitalized into higher land prices all across the country. In some markets, the land prices are moving up 10% a year. And people are taking on much higher levels of private debt in order to acquire residential properties. All that's great as long as they remain employed and their income remains stable. We have a recession with unemployment. All of those mortgage loans begin to default. And then you're going to see a rapid crash in residential property values. The banks or the investors in mortgage-backed securities are going to take another major hit. And I think the 2026 crisis may make 2009 look like a mild recession. Now, one last thing to cover tonight. which is really, I just added this recently because there's been so much news about it. If you're reading the financial news, the general media isn't talking about this at all. And that is the possibility that the International Monetary Fund would begin to take responsibility for issuing a global currency in the form of what's called special drawing rights. This is something the IMF has had since the Bretton Woods conference, but not much, it hasn't been used very much. This is basically the idea of the special drawing rights as put forward by Keynes and other economists, was to eventually replace the US dollar as a global safe harbor of currencies. And this would take the US off of the central role that it's had ever since Bretton Woods, and it would put it into an international agency. Whether the IMF is capable of handling this, I don't know, but the political considerations since Bretton Woods have made it impractical for the IMF to take on this role. So not much of the special drawing rights have been used, but basically the idea is this: every member in the IMF makes a contribution of its currencies. And then members can draw on, if they need, like, for example, let's say South Africa needed British pounds, then it could go in and ask for special drawing rights, exchange those drawing rights for British pounds so they could pay off the debt that it owed to British companies or whatever. So it's designed to help countries that have a short-term currency imbalance. And it kept Bretton Woods going when that occurred. Now, what's happened more recently, unfortunately, is the pandemic has really ignited pressure on the IMF to help provide financial assistance for many countries that have been devastated economically by the pandemic. Since the IMF's dollar assets are limited, they only have, I think, $1 trillion. Sounds like a lot of money, but for the amount of problems, currency problems that many countries have, $1 trillion isn't going to go very far. So the solution that's being advanced is to issue these SDRs, and then they could be exchanged for needed sovereign currencies by the IMF member countries that need them. Now, one of the concerns in the United States, and specifically in the last presidential administration, was that this idea has come from China. The head of the Chinese central bank here has been really pushing hard to get its trading partners to replace the dollar and use SDRs in its place. And basically, he says that the idea is to get the dollar disconnected from economic conditions and sovereign interests of a single country, so that neither the United States nor China nor Japan nor Germany or any country would be able to call the shots with regard to the money system. Well, remarkably, just a very short while ago, Janet Yellen, who is the new Secretary of the Treasury, has at least supported increasing the allocation of SDRs in a letter she wrote to the IMF as a strategy to provide liquidity for the financially poor countries. And quite a few members of the US Congress have basically signed on to support this move as well. Yellen stated in her letter to the IMF as follows: without further international action to support low-income countries, we risk a dangerous and permanent divergence in the global economy. An allocation of new special drawing rights at the IMF could enhance liquidity for low-income countries to facilitate their much-needed health and economy recovery efforts. Well, here's the last slide I have to show you before I finish up tonight. Here is the the chart that shows debt as a percentage of GDP. So if you're talking about a country that's deeply, deeply in debt, and with the brightest red, the United States is right up there behind a few of the countries in Africa, and Japan has very heavy debt as a percentage of GDP. So how would this money be allocated if it was created? And a major question for the global financial system, what would happen if SDRs take the place of sovereign currencies? If everyone was moved to use this, how would the quantity be regulated? How would they be distributed to countries? But I wanted to at least put this to you because this is now under serious discussion. And I quite frankly haven't spent the time to try to analyze what the overall economic effects would be. I just revert back to the problems with the euro, that one currency sounds great, but there's nothing backing it. If the SDRs were issued, there's nothing backing it, no gold, no silver, no construction bricks, nothing. It's just whether the IMF would have a mandate to do take certain steps whenever the global economy needs an infusion of cash, or whether there's a threat of inflation and it has to pull cash back out of the global economy. And we're in a world now where countries are not exactly working together for the common good of all. So all I can say about this is follow the media, stay tuned. I don't know what's going to happen, but I think it's a big piece of news. So we have reached the end of lecture 4, and it only took us 6 weeks. So it's past our quitting time. I'm going to stick around for a few minutes if you have any comments or questions. But next week, I'm going to cover Henry George's ideas on money.
Looking forward to that, Ed.
Well, everyone seems to be satisfied that they've had enough. So we'll say good night and have a great week. And I hope to see you all next Monday.
Thank you, Ed.